think the recording is starting. Okay, welcome to week 6 and back from the break. One of the things about studying online is that it's a little bit challenging to know whether you're on or you're off in some ways, because often we find ourselves so busy trying to juggle everything else in our lives that the week off is just a bit of a catch-up week or something. I remember when I was an undergraduate, this was back in the days when people actually used to go along and sit in front of blackboards and stuff at universities, and we had a term break once, and I was studying computations, which was a different sort of computations to what I'm running you through here. It was engineering computations for coordination and so on, and we had an assignment that had to do with applying statistical corrections to an entire set of coordinates, and it was pretty tricky stuff. But by comparison, what we're doing today is not that challenging. But anyway, the curious thing was that we went on holidays. We had the midterm break, and I thought, oh, this is fantastic, be able to put feet up and all the rest of it. The only problem is we had this huge assignment to do. And this is in the days when you get really excited if you had a calculator with a memory in it, let alone something that had programs and connected to the moon and all the other things that we take for granted now. But anyway, during the break, it turned out we had better attendance in class than we did for the rest of the term, because everyone was in the uni, because it was the only place that had the most powerful calculators. They were all sort of strapped to the desk in those days. But yeah, so we spent our holidays kind of merrily punching buttons for about 5 days non-stop. There you go. Anyway, I hope you guys had a little bit more of an enjoyable time. It used to be my favourite time for catching the end of the ski season in this part of Australia. Since I've had children to look after and stuff like that, and don't get down the snow nearly as much as I used to. But anyway, okay, this week we're going to be applying what we have been working up to pretty much what I think of as the most useful. I was going to say the most exciting, but I've just been on a webinar this morning where every second word was amazing, and in between the amazings was exciting. And I thought, oh, I don't know if I'm ever going to do that on a video again. But anyway, the maths we're going to be doing, we're going to be looking at capital budgeting. Now, capital budgeting sounds really impressive. It really comes down to using mathematics to decide whether we buy or sell stuff. And the stuff that we're usually looking at are things which technically are referred to as capital assets. And capital assets are, well, like all assets, they're things that we own to earn a profit. But in addition to that, there are things that we own over a period of time. Usually it's defined as over 12 months. So a pencil is not a capital asset, but notionally a computer is, because we'll keep it for a bit longer. A factory is a capital asset. A photocopier is a capital asset. The paper and the toner and stuff that go in it are simply current assets. Okay, I've been talking about capital assets that are physical things, factories, photocopiers, computers, that sort of stuff. As well as that, investments are capital assets. In a kind of roundabout way, money is kind of in that sort of ballpark too, and we certainly think of land as a capital asset. So it's basically anything that you own which you keep for a long time and for the purpose of earning some kind of a income from it. And that's really the trick with capital assets. They're things which have future cash flows associated with them. Typically, you have a cash outflow to begin with, and then you have a series of cash inflows. The most interesting capital assets are ones which are at least a little tiny bit soft. Things like shares in companies. They're considered soft even though the company behind the shares is pretty seriously physical. And I think we've talked about that before. It's an important concept to get your head around. Capital assets have their value because of the future cash flows that come from them. Now, excuse me, we're talking about capital assets. The important thing is that they have sets of future cash flows. So far, we've been edging towards the idea of these valuing future cash flow, like sets of future cash flows. And last time we were talking, we were looking at share valuation. And a share is a form of a capital asset. The shares that we were looking at in week 5 were relatively well behaved in that they would provide a dividend, the dividend would grow. If we really want to look at the curly ones, we'd sort of say, we'd look at ones where we're just like a startup company where the first few years they're growing at an unusual level and then they sort of settle out, okay? It kind of leaves us into the idea of, could almost describe them as misbehaving sets of cash flows, not nice, tidy ones that sort of, grow at 3% per annum or what have you forever, but rather a future set of cash flows that are kind of all over the place. Supernormal, subnormal, what's normal anyway, sort of pattern off into the future. This is the sort of thing that happens when the capital asset might be, for instance, some production line that you're thinking of doing. You might be running a company and you're thinking about starting a new product. And that product might require a lot of capital investment to begin with, to set up a production line, to do a bit of R&D, to go and get worked out what it is, to do a lot of marketing. And then you might think that over the next few years, you're going to start to get income coming out of that new production line. So you might be, I don't know, canning food or something. And you might be going into maybe bottling instant coffee. You've been canning beans and baby food and who knows what else, dog food, and then suddenly you decide to go into bottles and use instant coffee. So it's like a slightly different, but still kind of related. Now, the sort of sets of cash flows that are likely to come from that process or that innovation, that new line of activity, could be very misbehaved in that they might have the character of a lot of costs up front. The costs might take a couple of years even, so it might necessarily be a simple thing, a simple cost. You don't just go down the street and sort of buy a production capacity for instant coffee or something, become a competitor to Nestle's or something. The rate of change of those cash flows over time might be a bit irregular for a whole lot of different reasons. You might have a whole lot of boffins out the back calculating, what's going to be happening with how much you're going to be spending on marketing and what's going to be happening with franchises and suppliers and logistics and, lots and lots of complicated stuff. But the bottom line of that is that new line is going to give you a set of cash flows that you kind of, you're confident to predict what they're going to be, but they could be all over the place. They're not some simple pattern. And what you want to do is decide whether you do start that new production line. Could be IBM going from making computers to making mobile phones, for instance, like kind of related area, but really not what they normally do. I'm kind of giving this preface to get you thinking about the way that we're looking at these sets of cash flows that are just all over the place, and how do we bring those back down, and how do we justify the price, the cost. To a certain extent, the very first week when we looked at present value of things like loans and whatnot, those exercises, it communicates the idea that financial value is the present value of something that's going to happen into the future. If it's Uncle Pete going to give you his inheritance in 5 years' time, then it might be a simple event and you want to bring it back to the present and say, what's it worth to me today? In these cases, you're going to have just this hodgepodge of cash flows off in the future. I've mentioned starting a new production line, also mentioned a photocopier. I might want to decide or get a financial expert to analyse whether it's a good idea to buy a photocopier rather than to lease it. In one case, I've got the initial cost of the thing, and I might expect it to last for, I don't know how long a photocopier in a business environment works, let's say 5 years. and I know that it's going to cost me a few $1,000s today. 5 years time, I'm just going to have to put it out in the scrap bin or something and buy another one, and there might be service or service contracts between now and then, and I can sort of work out the cash flows associated with owning the photocopier. I can also work out the cash flows associated with leasing the photocopier. So I say, yes, I want a photocopier. It is a capital asset because I'm going to keep it for a few years. And I'm wanting to decide whether to lease it or buy it. I'm going to be using exactly the same mechanisms, the same mathematical tools that we're going to be looking at today to decide whether to lease or buy the photocopier, compared to buying a armful of shares in some subsidiary company, or maybe taking over a company, or starting a major production line, or maybe setting up a subsidiary in a new country. All of these things, from really little domestic things right up to buying jumbo jets and stuff, all use exactly the same mathematical technique and the same concept, right? So that's what we're doing today. I think it's pretty interesting, and it's also not that hard. I should say it's really, really easy. That's probably a more positive way of putting it. It really, once you learn that magic expression that I keep telling you guys about, 1 + I to the n, then doing what we're going to be doing today is actually really, really easy. The important thing is just get an idea of what's happening, like a concept, a common sense kind of idea of what's happening, and then apply this relatively easy mathematics to it, and away you go. You get these fabulously useful answers. Okay, with that said, we might move into sharing the screen, and we'll look at what the PowerPoints are telling us. Now, can you guys see the screen here? The PowerPoints? Yep, got some nods. Yep. That's fantastic. Great. Okay, that's what we're going to be doing. And if you want to download these PowerPoints and have them sort of scrolling along, as you're watching the Zoom or something, then you're most welcome. Okay, because you might even be able to see them better in real life, or as much as that real life on the laptop screen or something is real life, as actually sort of see it through the Zoom window. I'll be coming in and out of those, and I'm also going to be playing with a little bit of a spreadsheet. We're going to be building a model the way that we have over the last few weeks. Okay, let's see what the PowerPoints are telling us, right? And this is where, like the PowerPoints before, this week, there's, normally there's 70 or 80 of them. I think now there's sort of over 90. I don't even vaguely attempt to get through 94 PowerPoint slides in 2 hours. You cannot do that. However, what we're giving you is a set of notes. Happens to be on the PowerPoint file, right? So as we chew through these, we'll see what they're telling us. Okay, I've done a little bit of a background here, so we're actually going to be able to just basically go through a few slides as we go. We're going to be using this example. Now, I was talking about buying or renting a photocopier and using this capital budgeting technique to do it. Here's an example, which is whether to buy one sort of forklift or another. And we can use this technique to make that decision. In this case, we've got 2 different brands of forklifts, and we've got some cash flows associated with them. I guess we're assuming that after the end of the 3 years, we don't need the forklifts anymore, and so the $2.1 million here at the end, or the 2.8, represents actually selling, second-hand forklifts. So we buy them for about $3 million. They earn us some useful benefits to our company. So we express those in terms of the cash flow benefit, maybe compared to getting some contractor to come in and rent us forklifts or whatever. One way or another, we've got somebody working out what the cash benefits are of this particular physical thing is, and then we get to the sale event, or the salvage event. And you look in the textbook, it'll often talk about salvage value at the end, because think of the 3-year-old forklift. I still think of a 3-year-old forklift as pretty close to new, but maybe I'm old-fashioned. If we're talking about a computer here, maybe a PC versus a Mac or something, we could maybe have an entire system of computers and have exactly the same sort of comparison numbers here. Doesn't really matter. But if we're talking about computers, 3-year-old computer, it's pretty close to throwing the bin stuff and you get another one. Okay, so these represent notionally all of the cash flows involved in the project, either one brand or the other brand. What I'm going to do, I've just over here, I've taken the numbers for the first one, the Otis forklifts, and I've just written it in down there. And I've done that just to make life a little bit easier for us. And so they're the cash flows. Now remember, our convention is that the cash flows happen at the end of the respective year. So time naught means at the end of no time at all, which is right now, so the beginning. And then we've got another cash flow, 979,000 at the end of the first year, 1.3 million at the end of the second year, and 2.1 million at the end of the third year. They're the cash flows that we're looking at. And we want to know whether it's worthwhile buying these forklifts. If we simply add up the numbers, we can do that by using the sigma key here. Actually, I'll put this up front and center so it's pretty obvious. Now, I know in the past we have a problem with the resolution from the Zoom recordings. And so I'm going to just blow up the screen, so hopefully even with a lower resolution recording, you guys can still read it pretty easily. It seems that talking Mr. Zoom into giving us a higher resolution result is mysterious. Okay. What have I done there? I've simply used the sum function. I've gone up to the shortcut key up here in the menu, but I could have just written in equals SUM open brackets, the cell array that I'm summing, and then close brackets, and I'd get that sum. And that tells me that over those 4 years, the good news is that I'm ending up 1.3 million in front as a result of having that forklift. That looks really good. I'm going to put the numbers in for the other one. Now I'll have to write those in by hand. I'll come down here. 1, 3, 7, 4, 0, 875, 336, 17, 65, 2865. Oh. And as I've said in other classes, open yourselves up a spreadsheet, and while you're watching me do this, type in those numbers yourselves. Okay, and you can probably actually get in front of me a little bit because you don't have to do all this talking and carry on. And if you're actually doing this yourself, you're actually learning how to do it, you're getting that experience, and so it's a really nice way to learn and for these things to kind of sink in. Right. Okay, let's do the same thing here. I'm going to do my auto sum, and I'll just sum those, point, click and drag. Hang on, it'd be helpful if I put the minus number at the back here, because to buy these things in the first place cost me money going out of my pocket. By convention, I put it in as negative. And so this set of forklifts is going to cause me eventually to be in front by $1.3 million. This set of forklifts is going to cause me to be in front by about $1.68 million. So that looks like I'd actually go in and buy those ones. Okay, that's pretty easy. What's the problem there? The problem is that I haven't taken account of the time value of money. When I'm in business, I'm expecting every dollar in my business to earn me some sort of a rate of profit. And so simply getting my money back with a bit left over after 3 years, I'd say, yeah, okay, I've made $1.3 million out of that. I'll put 3 in and I've got, must be about 4.4 coming back to give me that excess. I'm sort of happy. But what sort of rate of profit have I got? You know, yes, I've got $1.3 million, but is that a good rate of profit or a bad one? I don't know. And so this level of analysis, while it's kind of useful to a start, it doesn't really tell me a great deal, because it could be the case, for instance, that let's imagine that this first one, something was to happen, and these last 2 cash flows actually happened out here somewhere, right? And I had to wait an awful long time for this money to come back to me. And so even though, in fact, I probably should have done it with the other one. I'll bring that back and maybe put these ones out here. So what's happening is that here I'm getting $1.368 million, $1.3 million coming to me in excess. I think I'm pretty clever because it's more than the 1.326. However, in the second case, I've actually got to run up to about 5 years to go and get my money back. Whereas this is an earlier one, I actually get my money back a lot earlier. Right? Simply adding up the numbers simply doesn't give you an answer as to the disadvantage of this extra weight, okay? Because I'm not taking account of the fact that year by year by year in business, I'm expecting all of my money to be earning me some kind of a profit. So clearly this approach, while it's kind of useful as a starting point, is really not that useful in the final analysis. Okay, what we're going to do now is assume, or we put into our consideration, the time value of money. We're going to add an extra variable. The extra variable I want to add is the discount rate. I'm going to say that the discount rate here is the rate of return, the rate of profit, if you like, that I'm expecting in my company for every dollar that's in the company. If I sell a share that's worth $1, that dollar has got to be turning me some kind of a rate of profit, some sort of a yield year by year by year. And so I'm going to consider that number, and I'll put in 10% just to put in a number to begin with. I'll format that to blue because I like blue text for data. While I'm at it, I might even do those in the blue as well. These are my data numbers. Okay. Just get that out of the way for the moment. And I will, actually, I'll just park these somewhere for the moment. I'm going to come back and look at them a little bit later. Okay, those two sums. Excuse me, not COVID. Hang on, I'm going to do a not COVID. Excuse me, John, ladies. Okay, these are my first attempt at doing an evaluation here, right? But now I want to put in discount rate. What I want to do is turn this 979,000 I have to wait a whole 12 months to get back to present value numbers, that present value dollars, because I can add present value dollars together, whereas I can't add $1 today with $1 in 2 or 3 or 5 or 10 years time, because it's different value. And to do that, I'm going to introduce a practical thing. I'm going to call it a discount factor. Okay, I've got a discount rate, which I give as data. That's my expectation of my standard rate of return. And I'm going to use that number to produce this discount factor. Now, just kind of in the margin here, if you like, I'm going to write up my favorite expression that I want you guys to know really, really well as the most important piece of learning for all of your mathematical finance. 1 plus I to the n. Where's my font key? Font, superscript. Okay, there it is, 1 plus I to the n. That's the magic number. Now, you guys have heard me talk about this many, many times before, and I'll probably chirp it along until we finish the class. 1 plus I to the n. We're going to be applying 1 plus I to the n to take the future value, and I'll put in here FV for future value, and I can use the 1 plus I to the n factor to go from the future to the present or the present to the future, depending on whether I multiply it or divide it. In this case, I'm going to be dividing the future value by my 1 plus I to the n values. And so my discount factor is going to embody that division. All right? I'm going to do that this way. To keep things easy, I want to be able to multiply that number by the discount factor to get this number. So this number needs to be less than 1. Why I do that is that I evaluate 1 plus I to the n, but then I might put it in the form of a division. So my equation is 1 divide by, in other words, giving me the reciprocal of 1 plus the discount rate. I'm going to make that absolute by hitting the F4 key in the Windows world. Close brackets. I'm going to raise it to the power of the year I'm in. So that's the equation. Why do I have the absolute on B2? It's because I always want this equation, regardless of where I put it in the page, to always go back to B2. C3, I haven't bothered to absolute it because I want it, as I fill this across here, I want it to actually catch the relative address, which is 2 cells directly above the one that I'm in. So that's like a relative address. And so that's the equation I want. The neat thing is that equation, regardless of what the discount rate is going to give me a value of 1. And we were talking about, there's a lot of discussion about rounding and stuff over the break, people doing the assignment and concerned that they're going to lose marks because they round either too much or not enough and that sort of carry on. You notice this? I can put this into 15 decimal places, as many places as Excel works the numbers out, and it'll always be 1. And it's pretty much independent of what the discount rate is. Let's say 2,337.5%, right? That's a pretty big discount rate. Doesn't make any difference, right? Because of the lovely way that raising anything to the 0th power always comes back with 1. So let's go back and put that to 1, to 10%. Away we go. I've written this equation a particular way. By writing it in the particular way with the absolutes and the relatives and stuff, I'm able to then just simply fill this across by grabbing it lower right-hand corner, dragging it across. All of a sudden, I've written 5 equations, or another 3 equations, sorry, without doing any work. And for lazy people, that's fantastic. And I like to describe myself as an extremely lazy person, as you guys have probably heard. Okay. Future value, I can divide by 1 plus I to the n, or multiply by this factor, which is the reciprocal. And remember, to divide by a number, you multiply by its reciprocals. That's all I'm doing here. It's not really any sleight of hand. It's just normal algebra. And that means that if I multiply the future value by the discount factor, I get the present value. And in this case, it's the same number because $1 today is worth $1 today. So, that's why that is a 1 there. This equation is also set up on cell addresses, and so I can fill it across as well. And now I can see that $2.11 million, I'll have to wait 3 years to collect, is really only worth $1.586 million today, because that's the present value. Now you see, I've built into those numbers my expectation for my business where I say every dollar in my business has to earn 10% per year or I'm not interested. Now I can do my sum. I'll sum these numbers, but here that's pretty meaningless. I'm going to sum the present value of all of the cash flows involved in this project, this decision, this capital budgeting decision. And whereas before, by simply adding the numbers up, I had $1.3 million of surplus. Now, the real net benefit, in other words, the future benefits less the present cost, the net benefit, the real net benefit, when I'm looking in terms of present values, which is the true comparable values, is only $476,000. Still pretty good. I mean, I'm still thinking, okay, then I'm getting my 10% that I really need for my business to flourish. Plus, I'm got $476,000 left over. So it looks like a good deal. So I'm very happy with that. I might even format that to dollars. You notice I don't often bother putting the dollar signs in the intermediate calculations and so on, especially when we've got a table of values. Okay, you don't have to follow that routine. But since I know that the future values are all in the units of dollars, I don't really need right through my calculation to put the dollar signs in. To be really tidy, I should do what I've just done there. Future value denominated in dollars. In some other calculation, it might be future value denominated in millions of dollars or thousands of dollars or even billions of dollars if I'm Mr. Morrison working out what the COVID crisis is going to cost me. Okay, so what this is saying is that in excess of my cost or over the top of my cost, and with every dollar working for me year by year at the rate of 10%, I end up with a present value excess of $476,000. I call this my net present value. And around the traps, you'll now start to hear this expression NPV very, very often. Net present value, NPV, is that. And if you've been typing away on your laptop as I've been yabbering away, you've calculated the NPV for that particular project, that particular set of cash flows, that particular capital asset acquisition. I can do a similar thing. This is for the Otis forklifts. I can do it for the other, the competing brand. Here, I'll just put these headings down here. So it just saves me a little bit of time. I'm also going to save time by simply copying those in because I'm using the same discount factors and the rest of that mathematics I'm going to bring in by simply copy and paste, and that's all going to work. This is interesting. You notice that when I simply added up the excess dollars, which is what I'd actually physically have in the bank, by the way, at the end of this, right? I might start off with a bank balance of, I don't know, $5 million in my forklift account. I'd knock out 3.1 million of them buying the Otis forklifts. But at the end, I would end up with 5 million, actually plus the 1.3 million, so it'd be 6.326 million. That's how many actual dollars I have in the bank at the end of the project. Right? However, from a decision point of view, I'm really far more interested in this, the 476. Because this one takes account of the fact that I'm factoring in how hard my money is working for me. And that becomes very, very apparent when I come down and look at this second case. This is a competitor, more expensive forklifts to buy. They appear to be giving me better value, stronger cash flows. They give me a higher accounting excess. I actually end up with more money in the bank as a result of getting the second set of forklifts, right? However, After I calculate it using the present values, the excess, the NPV, is only the $269,000. Right? So in a sense, I've got two ways of deciding what's the better deal here. I could say, in 3 years' time, when I scrap my forklifts, I'm going to end up with, what did we say? Start off with $5 million. I'm going to end up with $6.326 million in the bank. And if I buy the other forklifts, the Rolls-Royce ones, they cost me almost $1 million more. I'm going to end up with 1.368. So I say, yeah, okay, I'll go for the ones that give me more money in the bank. However, once I take into account that I really want every dollar in my company to work at the rate of 10% per annum, it turns out that the cheapo forklifts actually are working harder for me in terms of turning a profit than the Rolls-Royce ones, which in a sense aren't working as hard. It's a bit mysterious, that, I think, but believe me, this one is not working as hard in terms of what it does with my money. The net present value is not as high. Okay, this particular example, we're actually sort of jumping into a particular case where I'm comparing two mutually exclusive sets of cash flows, two mutually exclusive projects, right? Because in a sense, I only want one set of forklifts. I've got one warehouse. I only need one fleet of forklifts kind of running around in the thing. I don't want to have some of this brand and some of that brand because I'm going to have spare parts issues and I'm going to have two lots of servicing people to come in and, it's going to be awkward and ugly, right? So it'll only be one or the other, mutually exclusive. And here I'm using this form of analysis. The analysis is actually pretty easy. You guys, some of you have already done it because you've been tapping along with me. And it gives me a result which is not exactly what I'd expect. Oh, what's going on here? The nice thing about the way we've configured this model is that because we've built it all with equations, the data that I've put in, the blue numbers as the data and then all the equations, which are all the black numbers, I can change the discount rate and immediately I can see how that affects all of this deal. Okay. Let's say our discount rate is actually 15%. Okay, I started off with 10 and the accountant or the chief financial controller or whatever says, oh, no, you shouldn't be using a discount rate of 10, you should be using a discount rate of 15. Okay. What does that do? I hit the return and my model is going to change. This is interesting because at this point, the Otis forklifts, their NPV has gone down to 143. But the other, what was the name of the other ones? Craigmore. Forklifts, they only have, their net present value is actually negative. Now this is weird. At the end of the 3 years, using the Craigmore forklifts, my bank balance is going to be $1.368 million higher than when I started. But when I discount it back and do the calculations in present values, this is actually a negative number. All right. What's going on here? Okay. What's going on is the fact that we're taking account, we're kind of factoring into my calculations the fact that year by year there's a standard rate of profit which is being put in. And the NPV is going to be very dependent on the standard rate of profit. I call it the discount rate. Generally, and generally means in a normal situation where you've got a cost at the front followed by cash inflows for the remainder of the show, the higher the discount rate is, the lower the net present value is. Let's just do a few examples there. We've already actually seen what happens with a discount rate of 0. that gave us the two numbers that we started off with here. When we go up to 5%, see the Otis forklifts have fallen down to 870, 865, 10%, fallen again, 15%, fallen again. Right? So they're falling. And that's a fairly typical pattern. Okay. Go up to 10, 20%, and it's actually negative now. You see, the Otis are negative, the Craigmore are big negative, $500,000, kind of worse off. I still end up with the 1.36 or the 1.368, 326 or $1.368 at the bank. So I still end up making a kind of an accounting profit. But what I'm saying is that if I'm expecting my money to be working for me at the rate of earning 20 cents in the dollar every year for me, I would say I don't want forklifts at all, thank you very much. Those forklifts are far too expensive for my business. I have to find somewhere else, some other way of organising my what do you call it, storeroom, warehouse. Because I run the kind of business where I'm expecting to get 20% per year on every dollar that I put into the business. And obviously this is not doing it, right? And you say, oh, that's a bit rugged. I actually end up with more money at the end rather than the beginning. Why is it the small is saying, this is a dog, this is a bad thing to do? Okay. And the reason is that if I didn't spend the $3.1 million buying Otis forklifts, but I put it into some other part of my business which was achieving the 20% rate of return, then I end up with a lot more money in the bank. Okay, and I'm greedy. I'm a businessman, right? I want as much money in the bank at all as I can get. And I'm expecting to get money in the bank in 3 years' time, which represents the $5 million at the beginning, plus 20% for the first year, 20% for the second year, 20% for the third year. And I expect that to compound off into the future because that's the only reason I'm investing. Okay. You say, oh, isn't 20% a little bit high? It is for some businesses, not for others. An example probably useful for you guys to be aware of is that in the property development industry, the reference rate of profit that you normally use for a fair-sized development is 25%. So you expect a rate of profit of 25% per annum. And so if you're a property developer and you're putting money into a property development, you're not going to organise yourself or run a warehouse. Or if you do have a warehouse, you'll probably actually rent the thing or something because it's not worth your while to put your own dollars into that particular venture, right? Because your reference is your 25% as a property developer. Let's see what happens at 25%. If I was a property developer, I would see owning forklifts as a really bad deal because it's so much below the way that most of my capital is working for me. So I'm expecting 25%. If I'm doing something else where I get a far more modest rate of profit, a building company is sort of a bit lower, maybe someone producing white goods or a market garden or something, or a farmer, I might be down with a rate of profit down around less than 10%. Sometimes a good deal less than 10%, maybe 3 or 4%, and I'm happy. Okay. So the discount rate is very much dependent on the industry you're in, the expectations of that industry, to a certain extent the risks you're willing to take. Okay, we're not talking about the discount rate right now, we're just looking at the mathematics of how it works. Okay. There's an important thing here though, because this NPV has gone from positive to negative. And that's important. Oh, well, is it important? And the answer is yes, it is. When the discount rate is negative, it means that the dollars you're putting into this venture, this project, whatever you want to call it, is not working hard enough for you. It's actually costing you money compared to what you expect to get. So for the property developer, expecting 25%, every dollar I put in here is basically costing me. And this particular project is costing me almost $400,000 compared to what I would have been able to get if I put it into a comparable investment in my industry. Okay. At 20%, I don't know what business runs at 20%, but maybe it would be quite a few. It's still not a good idea for me to own forklifts. 15%, yes, it's a good idea. It's actually earning me money. What it means is that if my business is intending to earn a rate of profit of 15%, buying these forklifts earns me 15% over the 3 years, plus $143,000 just in my pocket, sort of free extra bonus. Okay. And so the whole thing about net present value is that I'm happy to invest in capital assets when the net present value is either zero or positive. If it's zero, it means I'm expecting to make whatever it is, 15%, 13%, whatever it is. I'm getting that and I'm just getting it. So I'm happy because I'm getting what I expect. I'm not over the moon because it's not giving me an excess the way it is right in this situation. But I'm not going around with a long sort of face on being really sad because I own forklifts and I really shouldn't, like the poor old property developer. Okay. Okay. A zero NPV is the decision criteria here. Okay. So that's really nice. If I've got a positive net present value, I do something, like I buy something. And if I've got a negative net present value the way I've got here, I don't. Easy. Okay. Okay. Let's go a little bit further. One of the problems with this form of analysis, by the way, this analysis is relevant. I think it's pretty easy. Okay, if you guys have done it once or twice, you'd be saying that too. If you're there and you're kind of 3 weeks behind in the notes and you haven't been doing any practice the way I keep asking you to do, yeah, you'd say, oh, that's damn hard, right? But it's pretty easy. Okay. And it's very powerful. Okay. The decision criteria is a positive NPV. Well, at least not a negative one. Okay, so zero NPV gives you, if you like, the baseline, and then zero or positive, you do it, and negative, you avoid it. Okay, that's really easy. And you've got to remember what the decision criteria is there. And if you've got two projects competing with each other, you go for the one with a higher NPV. That's pretty easy too. Okay. If we're using the 10% discount rate here, we can say, well, this choice gives me a higher NPV than this choice, so I'll go with the choice that gives me the higher NPV. So we've now got two sets of decision rules depending on what kind of a question you've got. If I'm going to consider anything at all, I will only consider those things with a positive net present value. And if I'm comparing two different projects that are mutually exclusive, do I get this or do I do that? Then I'll go for the project which gives me the higher net present value. Okay, two rules for two slightly different situations. Okay. If both of these numbers were negative, by the way, let's go back up to 20%. Both of these numbers are negative. Yeah, sure, this one is looking better than this one because I'm losing less money. But hey, why lose money at all? I'll just not do it, right? So don't do any projects that give you negative NPVs. And if you've got competing projects, you go for the ones that give you the higher net present value. That's pretty easy rules, okay? And that's especially the case when you've got a situation like this where you've got mutually exclusive projects. And there are other mutually exclusive projects that you might be doing. You might have a factory and you might be able to be producing plastic parts for backyard pools. And you might be able to sell those parts for a certain amount of money. Or you might be able to make plastic parts for the building industry. to, I don't know, something that builders would use. Right? When you do the numbers, you might find that every plastic part you make for the backyard pools, you can sell for $20 or $30, even though it costs you 20 cents to make, which is pretty close to the way the pool industry works. And so you might choose to make that project with your plastic manufacturing capacity in your factory, and you won't choose to make the parts for the construction industry, maybe buckets to keep concrete in or something, okay? Because you can't make as much money out of it. They're sort of examples of mutually exclusive properties, mutually exclusive projects. Another very important case is the question of redevelopment of land. I'm a property economist, so I tend to think a lot in terms of property finance and investment. And for instance, if I own let's say a car park in some central, like the CBD of some capital city, I might have this block of land, I'll make a certain amount of money out of it as a car park, but I can either build a 5-star hotel on it, or an office tower, or a shopping complex. I can't do all three. And so I might scratch my head, look at the cash flows and all that sort of stuff. But I can only do one of those because I've only got one block of land. Another example of mutually exclusive projects. Okay. Right, that's the net present value method. It's a really elegant method. It's relatively straightforward. It has one haunting downside. And I've seen this in consulting practice, and it sort of tickles you a little bit, but it actually is a little bit sad too, because it gives you an idea of the level of financial literacy and education that you find in very senior areas in the investment world sometimes. A lot of people thinking about investing in large sums of money and very, very cautious about risk and stuff actually don't understand net present value at all. They're probably getting a bit light on the ground now because we've been using these methods for a long time, and there are a lot of people coming out of university know how to do it. But a surprising number of people don't like using net present value because it's such a really weird decision quantity. Okay, what is net present value? I've already shown you that the one thing that these dollars of net present value are is that they are not dollars in the bank. Because if you buy the Otis forklifts, the one thing that's absolutely certain as these things, if I know they're the numbers, then I know that my money in the bank, the actual money that I'm going to be able to see and count and sell for gold or whatever I want to do, is $1.32615.8. Okay? And yet I'm talking about this rubbery thing here, that depending on what I do with this number, which does seem to be very rubbery, I can just make it 5, 15, 20, whatever. This number here, what does it mean? I've been arguing that that's the better number to make your decisions by. You ever see that? You ever actually have it as a check coming in the mail at the end of the project? No, you don't. Right? This is a purely hypothetical number. It is the excess present value in dollars given a particular discount rate for a particular set of cash flows. The cash flows are concrete. To a certain extent, the discount rate has been decided. But when you get to present values, you're no longer seeing anything that you can carry around in your wallet. And by the time you add them all together to a net present value, while it's a fabulously important tool for making decisions, it's actually just in your head. Right? Now, you talk to people, and I've had these conversations. The net present value is such and such. Oh, good. Oh, that's the profit, is it? No. But it's really what you ought to take account of when you make the decision whether to buy this thing or not. Oh, so it's the profit. No. Right? It goes round and round and round and round. And in the end, what do you do? Right? And the reason for that is that in earlier and simpler times, people made decisions using things like rates of profit. or yield rates, right? Or some sort of a profitability rate. And as we go along, we'll sort of see some ratios. Ratios are all over the place in finance. Let me show you an easy ratio to work out. This project is going to cost me $3.1 to $3 million. And at the end of the first year, I'm going to benefit by $797,000. So I could say my rate of profit here is that in the first year I'm getting $979,000 as a result of spending $3.123 million. So I simply divide one by the other. It's really easy. Okay, end up, I've got to put a minus sign in there, sorry. And I'll turn it into a percentage. So I'm saying, that's fantastic. I get a 31% return on my money. For every dollar I've put in the first year, I've actually got 31% coming back to me. That sounds pretty good. Hope it goes on forever. In this particular case, it doesn't, but there you go. Okay, I call this number my accounting rate of return. I'm going to put all of these numbers, I'll put them in a different color. I'll put them in purple just to make something a bit interesting. Right. 31%, that's not too bad. If I was buying a block of land, a residential property as an investment, or maybe for $3.1 million, I might even be buying a factory or an industrial unit or maybe a set of shops or something for $3.1 million. And I'd be expecting to get rent on that. And so every year I'd be getting my rent check coming in, and I've spent my $3.123 million buying my real estate or what have you. And so I'd be getting a certain rate of return. Okay. If I was in real estate, I'd probably be calling that a yield. If it was a share that I owned, it would be a dividend or a dividend rate. Lots and lots of numbers, lots of names, sorry, for the same basic idea. Here, as a decision tool, we use the expression accounting rate of return. You can write accounting rate of return, brackets, yield, profit rate. There's this almost an endless number of terms that people dream up for this one very, very simple relationship. And it's extraordinarily simple. We've just divided one number by another. Now, the weird thing about this is that because these cash flows are changing year by year, the accounting rate of return is going to be changing as well. I'm going to configure this equation just a little tiny bit differently. I'll turn this first number into an absolute. And that just means I can be very lazy and just fill that across. Oh, hang on, that doesn't look right. D4. Absolutely the wrong one. There you go. Okay. So year by year, I've got 3 accounting rates of return. Now that does present a bit of a problem because you say, well, what is the accounting rate of return for this? Is it 68%? Is it 31%? Is it 44%? Right? To get around that in practice, what I might do, I'll just see if I can get one more cell up here. So I'll need another one. Okay, I might take the average of all of these. And what I'll do is I'll take, now Excel has a nice little average function in there. I'm going to take the average of my cash inflows. I'm going to divide that now by the cost. I'll make the whole thing minus, just to take account of the minus number in the cost there. And so that's giving me an average now of 47%. Okay. So what I'm saying there is that over the 3 years that my project is operating, I've got 31% in the first year, 44% in the second year, 68% in the third year. So that means I've got an average rate of profit of 47%, 47.49. really to work this out, I think you're really having yourself on to go and put 2 decimal places. So I might just take out those 2 decimal places. They're in there, right? But so what? Okay, that's the traditional way of working out the accounting rate of return. And depending on the circumstance, people will often work out accounting rate of return for the first year and work on that, especially for something like real estate, where the rent's not going to change that much year by year. Okay, and so working out your yield in the real estate world, because again, rent's pretty stable. The first year is probably going to be more or less the same as the second years, and so on. So you don't worry about doing battle with this kind of complexity and complication. But in this situation, you do have a bit of ups and downs, so it's a way of making it a bit more believable. I'll work out the accounting rates of profit for the second project. Oh, this is interesting, isn't it? Even though the Craigmore forklifts put more money in the bank for us, using an accounting rate of return as my decision tool, my initial accounting rate of return is only 21%, so 28%, so it's falling a bit behind the 31. It's higher in the second year, really high in the third year. But the average over the whole, oh, hang on. I think my equation might be wrong there. I need to bring that down to there. Sorry, folks. That one's right. Okay. So I've got 21, 43, and 69. And so the first year is a bit of a dog. Second one's kind of comparable to the other forklift. And this one is just a tad in front, but the average is actually behind. So the accounting rate of return, you see, I can use the accounting rate of return to make a decision whether I take the Otis ones or the Craigmore ones. And really a lot less calculations. A lot of people, and you guys would be able to do this, if you didn't have calculators, you'd be surprised how quickly you'd be able to work out these accounting rate of returns. So what's the rate of return if we're getting 875 coming in and 4.1 coming out? You'd be able to, now I'm not saying you can do this right now because you use calculators all the time, but I reckon if your calculator batteries went flat and you're living out on a desert island or what have you, and you had to do a whole lot of these calculations, after a while, you'd actually be able to come in and say, oh yeah, it's probably a tad over 20%, maybe 21%. You'd be able to do that in your head. Here, you look at this fella, and you say, oh, that's probably a bit over 30%. And you can sort of see that because that's a bit over 3, that's almost 1, so it's not quite a third. You know, you can do that sort of stuff. But we use calculators, so, you know, we're dependent on that sort of stuff. Okay. Now, what have we got? We've introduced now 2 different ways of making the decision. Actually, we've made 3 different ways of deciding which capital asset to go with out of these mutually exclusive ones. The first way we've looked at is where we simply look at money at bank at the end of the game. And that would say Craigmore is better than Otis. The second way we've looked at is the net present value approach, where we say Otis is better than Craigmore. And the third decision tool we've looked at is the accounting rate of return, which is making it look like Otis is in front of Craigmore. Okay. And all of those are valid ways of making the decision, valid, but not necessarily of equal quality. Which one is going to actually ensure that you make more profit? You really are serving the needs of your business. If you're self-employed, putting more money in your pocket, or if you're working for a boss, maximizing their shareholders' wealth. Okay. We've already discussed the way that this first method doesn't really count for much, right? We've seen the net present value does look fairly strong. because it does take all of the cash flows into account, and it responds to the financial environment, the expectation of making a profit. So that's definitely something which is promising. And then we've then looked at accounting rate of return. We've said the elegance of this is that it does give you a useful decision tool. It gives you a quantity for comparison, which you kind of understand. I understand if I take $1,000 down to the bank and ask for what interest rate they're going to give me on it. If one bank says 2%, the other one bank says 3%, it's really easy because I say I just go for the bigger percentage number. Here, I'll go for the higher percentage number. Right? And that's, again, why a lot of businesses, a lot of very wealthy people getting around, have never used anything more than accounting rate of return, even if they call it yield or rate of profit or one of these other names. Right? So the accounting rate of return is lovely, cheap and quick, back of the envelope or back of the postage stamp kind of calculation. You can do it in your head. And you can make a lot of money doing that. In this particular case, it seems to be moving the right way because it moves in the same direction as the net present value. Okay, so hopefully you're kind of seeing that this is a more interesting puzzle than it first looks, and there are more than one way to skin the cat. More than one way to solve the problem. Okay, we're going to take a break now, and then we'll come back and we'll do a few more of them, and then we might go back and have a bit of a look at the slides and make sure we're sort of tracking relatively well. So I'll take a break now for about 10 minutes. I'll stop the sharing, and if I stop the sharing, I can. Thanks, mate. Right, let's get back to work then. Okay, before the break, we introduced 3 approaches to capital budgeting, as well as looked at what the capital budgeting problem is. And we've got this example, this situation that we're working through. The last one we got to was accounting rate of return. Now, one of the big differences between accounting rate of return and the net present value is that the accounting rate of return doesn't take account of the time value of money. And that's the key to the take-home learning for this particular class. Capital budgeting techniques that involve discounting, which is taking account of the time value of money, are good, and ones that don't are bad. Now, that's what the textbook will say. I take a slightly different view. I know an awful lot of people who do very well, thank you very much, by using a yield approach or a accounting rate of return approach. Don't worry about the discounting methods. So while the theorists, and maybe I'm supposed to be one of them, would say, don't use accounting rate of return, I'd say, well, if it helps you and you make a quid out of it, then it's not such a bad approach. But all else being equal, and if you do know those future cash flows with certainty, which is something we never really know, then the discounting methods are better. Okay, and I do recommend that you read through the slides and so on, and the textbook to really see what's behind the thinking with that as well. Okay, there is more to this game though. Okay. In the old traditional world, where on the back of an envelope, or I would say more likely the back of a postage stamp, you do a calculation, call it your yield calculation, and make a decision on it. There was another approach which had some curious benefit, which had a interesting relationship with the accounting rate of return. And that was a thing called payback period. Might even give that another colour. What colours haven't we used? That's a nice colour. I like that colour.
We're unable to see your computer screen.
Oh, that's a fantastic idea. That's almost as important as reminding me to share the screen. Not share the screen, turn on the recording. How's that? Got it?
Better, thank you.
Yeah, no, and thanks very much for reminding me of that. Okay, I'm going to come out here and I will insert a row there, so I've got a bit of space. Payback period. Payback period mathematically is pretty much the reciprocal concept to the accounting rate of return. If I've got an accounting rate of return, a yield of 5%, which is probably not uncommon in real estate, what that means is if I get the reciprocal of 5%, right? What's the reciprocal of 0.05? Some guys will be able to do that in their head. They'll be able to say, oh, that's 20, right? If I've got a return of 5%, what that means is that in 20 years' time, my profit is actually paid for the cost of whatever it is the investment is. Make sense? If I invest $1 and I earn 5% return, that's 5 cents. So every year I get a check in the mail for 5 cents. Yeah? And I pile those up somewhere. In 20 years' time, I'll have 20 times 5, which is $1. And so at that point, I'll say, oh, wasn't that a marvelous investment? I can take all my pile of 5-cent checks and I can take them to the bank, get my $1, and after this, all the money is free. You know, so I'm a really happy little ducky, you know. And so that payback period is a useful measurement, and it is more or less the reciprocal of the accounting rate of return. For instance, here I've got a accounting rate of return of about 31%. Let's say that's about a third. What it means is that in about 3 years' time, 3 times almost $1 million is going to be almost the $3 million I started with. Okay, it's 31%, it's not 33 1/3%, so it's not quite covering it, right? But you get the idea, yeah? And so the payback period is more or less just the reciprocal of this thing. You know, the reciprocal, oh, let's work that out. 1 over that, 3.1, okay? So it's not quite 3 years, a little bit more. So in other words, in 3 years and 1 month, I will have my $3.1 million put back in the bank, if that's what I'm getting year on year on year, okay? It's not quite that simple because my cash flows year by year are a bit all over the place. But what I can say is I can work out how much is left out of my initial investment as I go year by year. I'm going to say I'll take from that number, I will take that number, and I'll put that fellow equal to that. I think you can see what's happening there. I should make that negative. A little bit of that. Okay, what I'm wanting to illustrate here is that if I spend $3.1 million today, in a year's time I get my 979. So in a sense, I've only really out of pocket now $2.1 million. And the way I've set up that equation, by the end of the second year, I'm really only out of pocket $785,000. And by the time I've got to the end of the third year, I'm not out of pocket. In fact, I'm in front by 1.326. You notice 1.326 happens to be this number down here, right? So what I'm saying is that it's taken me between 2 and 3 years to actually get out of debt, if you want to conceptualize it that way. I'll just turn all these numbers around, and that might be a more transparent way of making the point that I'm making. Okay. I'm out of pocket 3.1 mil. I'm out of pocket now only 2.1. I'm out of pocket now only 785. And here, bingo. I'm feeling really good. I'm in front, right? And so I can say that it takes me 2 and a bit years to get my return back. Now, it doesn't take a lot of nous to say the shorter that number is, the more profitable, the more attractive my capital asset is, my investment is, right? If it takes me 20 years to go and pay the thing off, that's not as good as if it takes 3 years. And here it looks like it's about 2 point something or other years. Let's work out what exactly it is. I can work that out by actually dividing that number by, I'll just put a negative in to get rid of my minuses and stuff. Okay. if I'm going to make 2.1 million in this third year, I only need to make 785 to actually pay off my debt, don't I? Right? So what I'm really saying there is that first year, I'm still in debt. Second year, I'm still in debt. But about 0.37 of the year into the third year, I actually clear the cost, right? And so I would say here, the payback period here is equal to 2 plus, because it's 2 full years, plus that number there. So it's 2.37 years. Okay. And that is a fairly common evaluator for the profitability, the attractiveness of capital assets, of investments. Right? People often talk about payback period. They use another term as well, and probably more in property. Another term. Okay, accounting rate of return, I said there's yield and there's profit rate and lots of other names for this simple division. Here, payback period is also commonly known as year's purchase. And so if that property that I was telling you about that's returning the 5%, that's got a 20 years purchase. And the shorter the year's purchase, the more attractive. And so if I had the opportunity of buying an investment property that's got a 20 years purchase compared to one that has a 10 years purchase, then I'll go for the one with a 10 because I'm in front faster. Okay. It's a relatively simple thing to work out. It's a little bit tricky when I do it with an ugly set of cash flows like these ones. But even so, the maths is pretty easy. I just work out, I sort of do it pretty much by hand, year by year, until I get to the point where I go from negative to positive. I work out what percentage of this last year's cash flow I need to get rid of whatever's still in kitty or in debt, or however you want to conceptualize it. Work out the fraction, add it to the number of whole years purchase. It's untidy, right? But it's easy. Yeah? Okay. Years purchase is pretty common. And it's not discounted. And the shorter the number. To give you an idea, a couple of years ago, I was talking to a chap who was involved in, he was an engineer, a communications engineer, and he was involved in the business of putting up mobile phone towers. And he was telling me that those things have a payback period on average of 10 months. What that means is that if Mr. Telstra or Mr. Optus or Mr. Vodafone or whoever they are put up a new mobile tower, out in the bush somewhere or in the middle of the CBD, they expect on average it to completely pay for itself after 10 months of operation, which when you think about it is a pretty attractive year's purchase. And if you flip it around, it's a pretty extraordinary accounting rate of return. And I shudder to think of what it'd do in terms of NPVs, but I tell you what, it's kind of pretty much out of sight. Right? And so if we were having this discussion and I was doing an in-house training session for, Optus engineers or something, we'd be talking about NPVs, would be just through the roof, fantastic. So we've got years purchase. Conceptualizing years purchase, I like to think of it as pretty much the reciprocal of the accounting rate of return or the yield. The calculation of it is a practical thing. You'll find details of it in the slides. Away you go. It's not discounted. The disadvantages with both of these, by the way, is that they don't really tell you the long term because they don't necessarily pick up all of the cash flows. What happens, in the fourth year, for instance? The payback period simply says that I've got my money back for my investment after 3 years and I stop counting, right? I'll give you an example. Mining. Okay, I might go in, dig some holes, put some infrastructure in, start my coal mine. Might cost me, well, I'll probably put another 3 noughts in front of here, a lot of money. And the mine starts to operate, and year by year, I'm making a bag of money. Fantastic, and mining's an important thing. and I can work out my year's purchase. I'm happy. But when we get to the end of the mine, usually the greenies or the environmentalists come to chase us. And they say, oh, you can't just walk away from this mine because you've got this great big scar on the landscape and you've got piles of, rubbish that you've pulled out of the ground and just put up in a pile, and you've maybe got a tailings dam which has got mercury in it. We want you to clean that up before you run away. And so while you might have your 3 years purchase here, over here in year 5, for instance, let's imagine, I'll just sort of scale this down a little tiny bit. You might have something like minus big number. And you go along and you work out your year's purchase, your payback period, and say, oh, it's a year's purchase of 2.37 years. That's fantastic. But you're not taking account of what happens in the longer term, right? And if you're running the mine and, again, you have to clear up all your environmental carnage, it doesn't pick it up, right? Whereas when you're taking the discounting approach and working out your present value, if this was a project that I was doing, I would be taking my cash flows all the way out to here. I would take all of the cash flows involved in the project. And so then I'd get a complete picture. You don't get that with the accounting rate of return. You don't get it with the payback period. You might get it with the accounting rate of return, but certainly not with payback period. Okay. Two problems, therefore, with the payback period. One is that it's not discounted. The second one is that it doesn't take account of what happens after you get past the magic payoff kind of time, right? We won't worry about that. That's a kind of an ugly possibility, but it's good for you to know about it. However, we can also do a slight variation on the payback period to take account of the fact that we should be using present values. Here, we took the present cost, which is the same as the present value of the present cost. That's not really a big deal. Here, where we're doing this calculation here, the calculation was last year's balance outstanding minus this year's cash flow. Fairly simple, right? What I could have done, though, is instead of using the actual accounting numbers, I could use the PV. So I'm going to just change my equation here, right? So now instead of taking off 979, I'm taking off only 851. I'll accept that. And I'll make that my equation running all the way out there. And so it gives us a different profile. We're still ending up going positive in the last year, so that's good. One other adjustment I've got to make to my equation here, instead of dividing by the future value of the third year's cash flow, I've got to do its PV equivalent. Right. So here what I've got is that the payback period used to be 2.37 using the future values, the accounting values, the actual dollars, the bank balances, right? Here I've got a discounted payback period. And that probably won't all fit there. What am I going to do there? I'll have to go and squeeze that down somehow. Yeah, you get the idea. Discounted payback period, right? I've adjusted my equation. So instead of using future values, I use the PV equivalents. You'll notice I get a different number. The number is usually bigger because I'm not paying off my cost as fast, because I'm paying it off in PV terms, not FV terms. And that's an attempt to adjust the payback period method to the importance of time value money. Okay, what are we up to? Accounting rate of return to sum, the net present value approach, the accounting rate of return, payback period, and now we've done discounted payback period. So I've actually done 5 methods of evaluating capital asset budgeting decisions. Okay. there's one more that we need to do, and that is to get around the problem that the net present value is an awful difficult thing to explain to clients and bosses. Right? The average boss who's got grey hair like me won't understand net present value very well. And he'll say, what's this dollar business and it's not a profit? I mean, sort it out. I can go up to him with an accounting rate of return. He says, you beaut, I understand a percentage number. If my rate of profit is this and my accounting rate of return is that, they're all in percentage. I understand percentage. Big percentage is good. Small percentage is bad. Bring it home. No, easy. So there's a lurking possibility in all of this, right? You notice right at the beginning, as we increase this number here went down. Right? So it went down, 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 down as the discount rate went up, 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 up. And the other thing I told you was that the decision criteria is you will take on a project as long as you have a 0 or positive NPV. You'll take on a project as long as it's not negative NPV, right? Those two facts actually give us an opportunity to work out a kind of a factor which is kind of lurking within this discounting regime. All I have to do is work it out. Now it's going to get messy. I'm putting a lot of numbers on this model here in a relatively small area of space, so I apologize for this looking a bit cluttered. I hope you're following me. I will just add a row here to make it a little tiny bit less cluttered. What I want to do now is work out what discount rate gets this to exactly go down to 0. I know that a discount rate of 15% is too small. I now notice that a discount rate of 20% is too big. This has got a minus number there. So now I try and work out what discount rate actually gives me 0. Where is it between those two numbers? Okay, and I can say, well, 15 to 20%, I'll go halfway, 17.5. Oh, I'm getting close. Right? Now, if you guys have been doing this modeling as I've been doing it, you can do this along with me as well, right? Now, some of you guys might be up to that. Others will probably have to do it after we finish in your own time. I'll put a couple of a few more percentage significant figures into that so we can explore this, right? So I've got that now minus. So what that's telling us is that this is a minus number, so the discount rate's too high, so I've got to bring it down a little bit. Let's bring it down to 17.4. 17.4 means that the number now is too low. So the discount rate is low, then the net present value will be positive, right? So I need to bring up a little bit. 17.5 is too big, 17.4 is too small, so I'll go 17.45. That wasn't very useful. Okay, I'm a negative number, so it means that 17.45 is too big. I know that 17.4 is too small, and so I'll go down to 17.42. What I'm doing? I'm only guessing, right? And I'm kind of aiming to zero in on the answer. So there's no science to this. It's just a matter of guess, and getting closer and closer and closer. Okay, I've got 17.42%. I'm getting pretty close. It's only $356 kind of outstanding out of 3 million. So I'm getting pretty close to the money, right? But you notice I'm drilling down here. I'm down to about a third digit in the percentage. That's the number is positive, which means that the discount rate is too small. I'll bring it up by just a tad. That didn't bring it up nearly as much as I wanted. It's getting close. Now I'll go from 17.424 to to 6. Still positive. You see how close it's getting? So I'll go to the next decimal place. I reckon 6 is well, I'll just check, right? If I go to 7 and it goes negative, I know I've gone too far. Yep, okay. 7, turned it negative, it's gone too far. I have to come back and do 6. And I want another decimal place in there. So I'll do 6.5 to see what that does. 6.5 is giving me a minus number, so it's too high.
Closest I got is 17.426219.
Excellent. Okay. Yeah, I'll buy that. I don't mind saving a bit of time. Okay, there's still $1 in there, so we need to go up just a little tiny bit, don't we? 192 or 19. We'll try 195. I'll probably take that up to $2. 3. Here we go. 4. Okay, let's go back down to 3. 1, 3, 8. Yeah, idea where I'm going with this. Oh dear. Okay, 5. I reckon 5 will do it. 5 in the next decimal. There you go. How's that? Right? Okay. You know the bad news? Someone's going to come along and say, but sir, that's only the nearest cent. Right? At that point, I say, go away. Right? I've done enough of this. Nearest cent's good enough for me, and I'll just put that back down to 2 decimal places. And I think, bingo, got it. Right? Okay. Excel has a function that will do that calculation for you. When it works out, solves this puzzle. Your calculator, you have a financial calculator, you'll usually have a method of doing this as well. This discount rate, which is the discount rate which gives you a 0 NPV, has a special name. It's called the internal rate of a return. And I'm going to take that number there. I'm going to copy it, but I'm going to paste the value only. And I'll turn it into a percentage, and I'll put a few decimal places in. Not too many. Okay. That's the internal rate of return. Internal rate of return, also known as the IRR, is the effective interest rate or rate of profit or discount rate that perfectly balances your whole pattern of cash flows. Right? Internal rate of return is the rate of profit which balances between the present and the future, all your cash flows. It's the discount rate which gives you a 0 NPV. And the elegant thing about it, okay, I'll get rid of all those silly decimal places because, most clients will just think you're crazy if you do that. And you might bring it in at 17.4. Okay. Your client will be able to understand this, right? Because they're used to the idea of an internal rate of return, an accounting rate of return. But you see, this is all over the place because it's not discounted and it's kind of just, depending on whether it's a big year or a small year, it's all over the place. Whereas you can sell this by saying this is how hard your money is really working, taking into account all factors. That's about as far as you need to go for most clients. And I was like, oh, really? Oh, good. 17.4%. That's how hard every dollar that's put in here is working in order to give you those cash flows into the future. Now, that is really elegant because it takes into account all of the cash flows, it's discounted, and it gives you a decision criteria which is really easy to explain to people who don't understand much about finance. And as a result of that, this has become a very popular tool for evaluating capital asset or investment decisions. Okay. Internal rate of return, it's a biggie. Now that sounds fantastic. I've just gone through, 5 or 6 different approaches to capital asset budgeting, and we've shown you the maths, and you've got it here, and eventually I'll put this model up so that everyone can copy it and practice with it and stuff. And the answer is IRR. The bad news is that it's not. Okay. IRR is popular. It's a discounting tool. It has the elegance of taking into account all of the cash flows. However, despite all of those attractions, it actually has a number of hidden downsides. Now, when you're using this, if you guys go into financial advice or go into property investment or something like that in your careers, really important that you understand what I'm about to tell you, right? Because you'll be using IRRs all over the shop, right? And they're really, really important. And your clients will be wanting them, and your boss will be wanting them. Your company will sort of, write the reports based on them and all the rest of it. But you've got to be able to sort of sit back and say, yeah, I'll give you the IRRs. I don't mind doing that. However, here's the caveat. Here's the things you've got to be aware of, because the wheels could fall off if you use this thing too much. Okay, here goes. A number of problems with the internal rate of return. I'll illustrate one of the problems by simply negating all of those numbers. Let's imagine that instead of spending 3.12 million, you're actually the Otis forklift company, and you're selling that. And I don't know how the other numbers turn out negative, but let's imagine that's kind of the flip side. A good example of this, for instance, is, by the way, a loan. Right? This capital budget situation is one that is, you spend the money up front and then you get the benefits coming off into the future. When you take a loan, you actually do the opposite, don't you? When you take a loan, you get the money, you go to the bank and you come back with a bag full of cash. It's fantastic. Show all your mates, here are all of my dollar bits, I've got a loan, fantastic. But then next year, you've got to start paying the stuff back, and the next year and the next year. And before you know it, you've paid back an awful lot more than you actually borrowed, especially if you're borrowing for a house. You might pay 2 or 3 times the value of your house over the 25, 30 years that you've got your mortgage, right? Okay. So I'm going to illustrate that by just negating all of these numbers. Now make that minus, that minus, that minus, and that minus. I find this the most powerful way of showing this. I've just made this a situation where you get $3.1 million today, and you then have to pay out these amounts over the next 3 years. And guess what? The accounting rate of return is the same. The IRR is the same, right? It's like, well, yeah, so what's more? What do you want about? The curious. I don't know what I've done there, but the discounted or the payback period should be the same as well. I don't know what's gone wrong there. That maybe there's some little wrinkle in my math somewhere. I don't know. I don't know what I've done there. Oh, that's right. The discounted payback period is a bit funny because there's something really curious. Discounted payback period at the internal rate of return is always the number of years of the project. Anyway, it's just a mathematical oddity. Anyway, my point of doing this demonstration, though, is that even though the IRR is the same, in the first project, you're aiming for the highest IRR. If I've got a internal rate of return of 15% on one project and an IRR of 20% on another project, I'd go for the one that gives me the 20%, wouldn't I? Right? because I want a higher rate of profit. That's normal. But here, the higher internal rate of return, just think about it in terms of a loan. If you went along to one bank and they said, we'll lend you money for your house at 5%, and you say, oh yeah, okay, I'll think about that. And then I'll go along to another bank and they say, oh, we'll lend you the money at 10%. Which loan would you take? You'd take the 5% loan, wouldn't you? Right. Here, it appears to be saying that this project, it's got an IRR of 17.4%. And the normal rule, by the way, with using IRRs is that you go for the highest IRR. But here, because it's like a loany kind of situation, you'd actually go for the lowest IRR. Right? In the same way you go for the lowest, the cheapest loan. You kind of with me with that? Okay. Yep. And so by reversing these numbers, inverting these numbers, what I aim to do there was to just illustrate the way that IRR can be actually telling you the diametric opposite of what you want to know. A couple of other problems with the IRR. If these cash flows are up and down, I was talking about the mine before. You spend money at the beginning to set the thing up, and then you spend money at the end to do the, what is it called? Regeneration, the reconstruction. The name escapes me for the moment. But in the middle, you're making a lot of money. So making minus cash flow at the beginning, minus cash flow at the end, sometimes a mighty big one. And then in the middle, you're making those positive cash flows. Depending on your pattern of cash flows, you can actually get more than one solution here. And in the slides, I'll just see if I can get onto the slides. They show you how that works. Most of the time, we're down, slide. We're down to slide 66. Most of the time, I'll just take this off screen a bit. Most of the time, as the discount rate increases, the NPV decreases, right? That's what we saw when we did those numbers. 5% was pretty high, 10% was a bit lower, 15% was lower still, 20% was underwater, right? So it's kind of falling, right? That's the pattern of the graph. However, depending on the pattern of cash flows, and what we've got illustrated here is a pattern of cash flows where the NPV is actually rising. You see, here's the discount rate, and as the discount rate increases, it rises. As the discount rate is rising, the NPV is also rising. It's going in the opposite direction. Peaks out around here somewhere and then starts to fall off. That could be the mine example that I was giving you before in words. Right. And there's actually two IRRs, there's 16% and there's 55% for this particular puzzle. The worst thing about this is that if you use Excel, its built-in IRR function, Excel is worked out, the algorithm inside it does the guess, the iteration behind the scenes. And Excel is programmed so it gives you the first positive IRR. You can actually have negative IRRs, which is really crazy, but you can get them depending on the pattern of the numbers. But Excel will give you the first positive one. It won't give you the second one. And depending on your cash flows, you can actually get multiple. You can have more than two. You can have 3 or 4 or 5 or 6 IRRs, depending on how many times the cash flows go from positive to negative to positive to negative. Right? So the multiple IRR is a problem. The other problem with IRRs is that, now this is a bit of a techo kind of question, so I won't go into it too far. You'll find it in the textbook. I don't think it's even in the slides. But there is an assumption in the internal rate of return mathematics that the intermediate cash flows, I'll just get that out of the way. So this would be considered as an intermediate cash flow, intermediate cash flow, or final cash flow, right? There's an assumption that these intermediate cash flows are invested at the IRR rate of return. Now, there are a whole lot of theoretical reasons. I don't have enough time to go into them. as to why that's a problematic assumption. So there's a number of issues with IRR. So IRR is really good because people understand it, but it has these hidden, if you like, mathematical kind of problems in it. But it still is very popular. Okay, what we've done today is that we've really covered, I think we've done at least 5 different forms of capital asset budgeting technique. The maths, okay, I'll run through it fairly quickly, but we have illustrated them all. So if you watch this video again and work through the model, and especially do it yourself, then you'll see that they're all relatively easy. In the textbook and in the slides, you'll see the arguments why one is considered to be superior. I would say in practice, always work out your NPVs. If you have to comment or like give your decision based on IRR, by all means do that, because if that's what the client wants, that's what the boss wants, would do it. Right? However, always check with NPV, because sometimes the decision that you get using IRR will actually be the opposite decision compared to what you get using NPV. And I'll let you read through that yourself. We've run out of time. I'll have to go, unfortunately. But go through those slides, definitely. If you can, the textbook's really important for this, because there's a lot of like theory and background in here. I think it's fabulously interesting and it's very practically useful. It's not hard, right? Once you've done this with a model or done it on your financial calculator on a piece of paper, you'll find that once you've done a couple of these things, are really easy. There are a number of other examples in the slides, so go through with different sets of numbers. That's a good way of cementing your learning. And I'll see you next week. Okay, thanks very much for your attention. Okay.
Okay, bye.
Bye-bye.
Bye.